Hey everybody, Corey from SB Pace here, talking about metrics and KPIs and reporting in the month of October for Project 365. I might have said that already. Doesn't matter. Question for today is how do I read my statement of cash flows? So I kind of touched on this already earlier this month, but your statement of cash flows is the most important of the three financial sheets, in my opinion, because it tells you where you're getting your cash, where you're spending your cash, and ultimately how much cash you have. And cash is king. And I don't care if you have a positive or negative net income, billions of dollars in assets, or a ton of equity. If you don't have cash, you are out of business. So there's three areas. You've got your operating activities, your investing activities, and your financing activities. And so your operating activities are going to be everything that you do in normal operations that make you money. Sometimes this can be a negative number as well, but generally it's net income, change in working capital, depreciation, that type of stuff. Is going to positively affect your cash flows. And then you have investing activities. For most small businesses, this is probably going to be a negative number because this is the money that you're investing into your business, whether it's capital expenditures, equipment, that type of stuff. It's possible to have positive numbers in there. Like if you, for example, loan money out to whoever somehow, or you invest in short-term bonds or things like that, and your company's making money on that. A lot of businesses do that when you have extra capital. You can invest that money in these short-term, drawing a blank on what they're called right now, but short-term investments where you can just make this money back fairly quickly. And that would be a positive number under your investing activities. And then your financing activities, positive or negative or non-existent, depending upon whether or not you have any debt. So if you're starting off a business and you take out a loan, you're going to have that positive number there in your financing activities. But then every period after that, you're going to have a negative because you're going to be paying that money back. But again, if you don't have any debt, then you probably don't have anything going on in your financing activities because that's all the money that you're borrowing, paying back. If you're paying out yourself, like distributions from your business, you're going to have a negative there because that's going to basically show that you're paying yourself for whatever investment you had at the beginning. And then at the end, you have your change, like net change in cash. So what you started with, what you ended with, or what you used, and then what you ended with. And hopefully that's a positive number, and hopefully it's larger than the previous period. That's the statement of cash flows in a nutshell.